Nei prossimi 30 anni la popolazione mondiale aumenterà di 2 miliardi di persone. A trainare il boom demografico saranno 8 paesi: India, Nigeria, Pakistan, Congo, Etiopia, Tanzania, Indonesia ed Egitto. Nel 2030 India e Cina varranno da sole 2/3 della classe media globale e il 60% dei consumi. Intanto l'innovazione parla sempre più diffusamente le lingue dei paesi emergenti. Qui le domande di brevetto hanno già superato quelle di Stati Uniti e Giappone. Demografia, consumi, innovazione. Sono questi i megatrend che si incrociano sulla mappa degli emerging markets. Siete pronti a questa rivoluzione in arrivo e a cogliere le opportunità di investimento?
Good afternoon, everybody, and welcome to our special event entirely focused on emerging markets. We are in the virtual space of We Wealth Must. That is our special space dedicated to the leading players in the wealth management industry. Today we will talk about the most attractive opportunities in the developing world, and we will discuss some very interesting ideas with some of the most skilled and well-known investors and managers, not only in Italy but in the world. Namely, in the first part of our conversation of this live event, we will share with you some ideas about the most favorite ideas and stories and countries and sectors according to the views of two international speakers. I'm referring to Mark Mobius and Carlos Hardenberg. Today they are co-founder at Mobius Capital Partners. In the second part of our conversation, we will switch to a roundtable involving three of the most influential opinion leaders and players in Italy. I mean Manuela Donofrio, Head of Investment and Solution at Unicredit Group, Furio Pietribiasi, Managing Director at Mediolano International Funds, and Gianluca Serafini, CEO and Managing Director at Fideuram Investimenti. Let me first remind you that you can watch on our social official pages in LinkedIn and YouTube, and of course on our website, we-wealth.com. I do invite you to share with us all your questions about emerging markets. We will give an answer in the following minutes, thanks to our guests. Please send the question to live@we-wealth.com. So here we go. Here we are again in the virtual space of We Wealth Must. It's my pleasure to welcome Mark Mobius. Good afternoon, Mark.
Good afternoon.
Mark, as we know, spent over than 30 years at Franklin Templeton, working and traveling throughout emerging markets and frontier markets. During that period, he was in charge of active managed funds, totaling something like more than $50 billion in assets. So thank you very much, Mark, for joining us. Today we speak with him as a co-founder at Mobius Capital Partners. And a warm welcome to Carlos Hardenberg, who is co-founder at Mobius Capital Partners. Carl has more than 20 years of experience in the financial markets. He also was in Franklin Templeton as Executive Vice President and Managing Director in the Templeton Emerging Markets Group. Thank you for joining us, Carlos.
Thank you, molto grazie. Thank you very much for having us here on the show today.
Thank you also for the Italian tentative. Thank you. Let me just remind you that after a few questions to Mark and Carlos, we will involve also the three Italian guests, Manuela Donofrio, Fulvio Pietrobiasi, and Gianluca Serafini. But let's start. I will start with you, Mark, if you agree. As we mentioned, you've been investing in emerging markets for more than 30 years. So, if you should pinpoint the one thing that makes emerging markets radically different now, as compared to the time when you started, what would you say, Mark?
The big difference is the size. When we started in 1987 with the very first Emerging Markets Fund, there were only 6 markets in which we could invest around the world. In Latin America, it was only Mexico. In Asia, there were 5 countries, and that was it. All these other countries were closed or restricted in one way or the other. Of course, there was no China, no Russia, because they were all communist countries with no market. So the big difference now is that emerging markets represent a very big portion of the global market capitalization. If you look at the numbers, emerging markets are probably about half of the global market capitalization, including the US, Europe, Japan, and so forth. You put those markets together and you compare them to emerging markets are about the same size. So we're now in a completely different environment with many, many more choices and lots of exciting prospects, because now we've got 70 countries around the world, in Latin America, in Africa, in Asia, in Eastern Europe, and so forth. So it's very exciting.
So it's a matter of size, as Mark explained to us. Carlos, when dealing with emerging markets, what about the main mistakes that investors usually make in investing in emerging markets? What can you say about that?
Yeah, I think that's kind of in relation to the question you asked, Mark. I think one of the big misunderstandings relate to the changes which have taken place in emerging markets over the last couple of decades. I was reminded very much this morning how things have changed. I was on a 1.5-hour due diligence call with a company in Kazakhstan, and this company is a $10 billion company which is doing e-commerce. They're competing with Alibaba, they're competing with eBay and Amazon. They have a mobile payment option. They have everything that's related to technology. They're competing with the likes of WeChat or WhatsApp. And it reminded me of my first visit to Kazakhstan some almost 20 years ago, together with Mark, where the only companies that we could see were commodity businesses, copper business. We went down the mine 700 meters below the ground to visit this company. So things have changed so dramatically, and this needs to be understood. The opportunity is different. The nature of the companies have changed. The sectors have changed. So you have to learn a different language in a way. And I think a lot of people talking about mistakes still underestimate also the risk that's associated and the opportunity associated with currencies in emerging markets.
Yes, it's very interesting to point out how the sector composition also of the indexes and of the opportunities, generally speaking, has changed. Mark, you mentioned that at the beginning, if I didn't misunderstand, China wasn't an investment area. It's very interesting to point out today how resilient proved to be China, both in terms of containing the contagion and in terms of market performances. Does that correlation hold true also for the other areas within emerging markets, Mark?
Well, the other emerging markets are quite different from one country to another. You find big contrasts. For example, if you look at Korea, Korea was very disciplined in handling the COVID crisis, like China has been. Taiwan, I would say, is in the same category. But then you have other countries in emerging markets, like let's say South Africa, who had a very severe lockdown, but were also affected severely by the COVID. So it varies from one country to another. But I would say this, generally speaking, countries in emerging markets are improving their governance of companies and also of governments. The governments are improving the way they operate their economies. And this is a very good sign for us, of course, because if you have a good economy, strong economy, then it's much easier for us to invest. But I would say China is probably in the forefront now as a result of recovery from the COVID crisis. India is coming along, but they, of course, are in a completely different situation. But for some reason, they are now recovering without necessarily having a very, very strict shutdown.
Investing at the end of the day is all about expectations and reality. I mean, outcomes, numbers are not positive or negative per se, but they are positive or negative relative to their previous expectations. So do you agree with this idea, Carlos? And where do you find a higher gap between what financial markets are pricing in right now and what is your own view? What do you see space for relevant, both positive and negative surprises next year? Carlos.
Yes, thank you. So I think if you want to invest successfully in emerging markets, you have to have a certain discipline that allows you to look beyond the next quarter, beyond the next year, and really understand what will happen over the next 5 to 10 years. The biggest mistake that investors make, another big mistake that investors make, is that they constantly try to time the market by investing into these markets, oftentimes too late, or by missing an investment in these markets. So we think that it's really important to understand what the big transformational changes are that are taking place. And Mark was talking about governance reform. Mark was talking about the changes that are taking place in companies and sectors. And these changes will take many, many years. And they are still very much underpriced, undervalued, and undiscovered. So particularly small companies, which are changing very rapidly, family-owned businesses, which are right at the market. They are really trying to understand how to position and invest family wealth for the next decade so the next generations can participate. This is our job to find those companies, and the opportunity really is everywhere, whether it's in Africa or whether it's in markets and smaller markets in Latin America, larger markets in Latin America or Asia. So I would say I would really recommend to look at the longer term prospects, particularly in those sectors which will see both private sector and public sector investments. And that is also education and healthcare, as well as technology. Those are the hotspots that we will hear more about over the next 10 years.
Okay. Thank you, Carlos. And what is your view about that, Mark? If we have to look at the next 5 to 10 years horizon, what are the countries and regions that are most attractive, that do look more attractive? Mark.
Well, as you know, Asia has done very, very well and continues to do well. But then if you look at Latin America, where the growth has not been as good as it should be, and Africa, you're finding the prospects for more rapid growth growing every day as a result of the spread of technology to those areas. So I would say particularly Africa has some very, very exciting prospects because it's a young population and it's a population that is now just experiencing the sort of what we call leapfrogging of the technology into their economies. So those, I would say, are the two interesting areas that we have to look at going forward. But nevertheless, Asia still has tremendous growth ahead of it, particularly in Southeast Asia.
Carlos, a minute ago, mentioned the small business segment and also some family business. I guess that is really the most fascinating as well as the riskiest part of the universe. Carlos, what can you find in this area, in this sub-segment that is not available in the larger caps?
Well, I think it's almost a philosophical question, but we all know, also partially from our own experience, the larger companies get, the more vulnerable they also become, the more complacent they become not to move fast enough. And they are then becoming subject to disruption from all kinds of corners. So I would not exclude us from making an investment in larger companies as well. There are some very exciting ones in emerging markets. But the beauty of small businesses is, first of all, every large business started as a small business. And we've seen that working with these particularly families and founders is a much more productive way of investing. They are willing to learn. They are willing to improve. They're very good at what they do in terms of running the business, but often they are happy to get advice with regards to governance, with regards to, for example, the board structure, with regards to transparency, what we expect from a business. So this kind of interaction is very fruitful. But last but not least, what counts to us is really to make a return on our investment and to make money. And we see that particularly right now, where you have a market situation where the ETFs are only buying large stocks, and they're ignoring such a big part of the universe. 95% of the universe is really small companies. That opportunity alone allows us to fish in a pond that is not very well discovered. And these companies will grow. Eventually, the ETFs and the passives and the large guys will have to buy them. And we'd like to be there early.
Okay, so if I didn't misunderstood, many people are looking at the same direction, at the same things. And so it's much more interesting to look at the sub-segments where nobody is right now. Mr. Mobis, Mark, what are the secrets, if you can share them with us, that allow you to distinguish a pure, resilient success story in terms of investment from a more fleeting one? What can you say about that?
Well, you must remember that a business is all about people. Organizations are about people. So the first step in research is to look at the people behind the company. Of course, the financials you have to examine. You have to examine the industry, the growth prospects for the industry, etc. But at the end of the day, the real secret lies in the management and the people who are controlling and running the company. If these people are well educated, well trained, well experienced, and are enthusiastic, by the way, they don't have to be old people. They can be very young people. As we know, some of the most successful companies have been run by young people, but they have to have a passion for their work. And most importantly, if they're a public company, we're investing in public companies, we need companies that will have good corporate governance, will pay attention to things like independent board directors, women on the board of the company, and all these other factors which make for a well-governed company.
So ESG is becoming more and more relevant also as regards investments in the emerging markets. Some minutes ago, Mark mentioned Africa as one of the most attractive and fascinating area and region for the next 5 to 10 years. Carlos, I would ask you, generally speaking, not only in Africa, but I would start from that. Which are the most attractive frontier markets? Where can you find really the most attractive stories?
Yes, frontier markets are really a big passion for Mark and myself. As you may know, we invested, we were actually running and managing a very large frontier market fund for more than a decade. And we have probably had a food poisoning in every single African country. So we had a lot of experiences on the ground. Africa itself is a very resourceful continent with very young people, with very hungry people, where you have different stock exchanges, both sub-Saharan Africa, Northern Africa, Eastern Africa. And we are seeing that they are moving very quickly from kind of, no consumption to very innovative consumption. So we invested in a technology business, which is a mobile payment app in East Africa, which is a market leader there. They're now moving into many other African names. So Africa as a geography is highly interesting because of the consumption potential, because of more political stability, because of higher income, which is coming through for local households. And that paired with more stability, more transparency is a good recipe. But we're also excited about places like Vietnam. We are looking at Bangladesh. So even in Asia, you have a couple of untapped opportunities. So there are different geographies we're focusing on where we do find opportunities. But I would still say the single biggest new frontier, the single biggest opportunity in emerging markets is still this transformation which is taking place in terms of the sectors, in terms of the nature of consumption, even in some more mature markets. I talked about Kazakhstan and our experiences there, but in every market, you are seeing this very rapid transformation and innovation that's visible in different sectors. So in China, for example, we're investing in the healthcare sector. In Brazil, we invested in medical diagnostics and telemedicine. All of this wasn't there 10 years ago. It didn't exist. And now these businesses are around, they're growing fast, and they're profitable.
Okay, so we talked about sectors, themes. Mark, could you mention also some names of companies that there are good candidates to become future champions, maybe not only on a local basis, but also on a global basis, Mark?
Well, if you look at our portfolio in our CCAV listed in Luxembourg, which I think your audience is familiar with, you will see a number of names that in the sectors that Carlos has mentioned. For example, in Brazil, we have a company called Fleury that does medical diagnostics. This company has been growing very rapidly and, of course, is in a very important spot as a result of the COVID-19 situation. Then we have companies in Taiwan, for example, that do the so-called fabless work on semiconductors. In other words, they design the chip and the software that goes into the chips to create certain abilities of, let's say, your cell phone camera to take good pictures, or for your speaker on your cell phone camera to work efficiently. So there are a number of companies that we're looking at, and Taiwan is probably one of the most important areas for that. And in the semiconductor area, the actual manufacturing is another area that we're looking at. The demand for semiconductors as a result of the growth of the cloud and the many items of equipment that's acquired in the cloud is something that is growing by leaps and bounds. So we're seeing a very, very big increase in semiconductors, memory semiconductors, and other types of semiconductors. And we see that continuing to grow. Interestingly enough, most of the most interesting companies are the smaller companies that are able to do very creative work in the design of semiconductors. As I mentioned, the so-called fabless companies. So that would be very good.
Okay, so again, small is beautiful. So thank you very much, Mark and Carlos. Now, we will switch to the roundtable involving also the other three guests. So please, we'll start in a minute. Stay with us. Here we are again with Wealth Master, and let me introduce again the three speakers that are involved now in the roundtable with Mark and Carlos. So a warm welcome to Manuela Donofrio, Head of Investment and Solutions at UniCredit Group. Good afternoon.
Good afternoon. Good afternoon, everybody.
And good afternoon also to Furio Pietrobiasi, Managing Director at Mediolanum International Funds.
Good afternoon.
Thank you also to Gianluca Serafini, CEO and Managing Director at Fideuram Investimenti. Thank you for joining us. I will start from Gianluca. When investors talk about emerging markets, basically there are a few doubts. It's the place to be to capture future growth in terms of economic growth, in terms of growth for businesses and investments. At the same time, over the last 10 years, I would say, emerging markets underperformed quite substantially the developed world. So, Gianluca, how could you explain that? What prevented emerging markets from delivering the extra return, the promised extra returns in exchange for higher expected volatility?
Thank you. Actually, I do think that the foreign investor portfolio flow and global financial conditions are still playing in emerging market a crucial role in the short term and the medium term. Since 2012, emerging markets have suffered a tightening of financial conditions, which was related to the tightening of monetary policy in the US and later in the US dollar strength. The relationship between US dollar and emerging market economic growth is well known in the literature. You can see interesting papers for IMF and Bank of International Settlements. A strong US dollar make it more difficult for this country to finance their current account deficit, forcing an economic rebalance, which in turn affect their trade flows. A US dollar strong forces some emerging markets to run a procyclical monetary policy to defend their currency at times when it is more difficult to get funding in international financial market. This can require them to run a monetary policy that is tighter than what the domestic economic condition would require. When there is a significant current account deficit, a rebalance is always necessary and is driven by the combined action of currency depreciation and weaker economic growth. To recap, a current account deficit which seems sustainable in a normal condition becomes unsustainable in a period of rising US dollar demand. But there are good news in a sense, because at least four of them. First of all, emerging market currency, excluding China, have already depreciated substantially and are trading to the 30 years low in real terms. Second, currency depreciation together with the tight financial conditions have already caused the necessary economic rebalance, and now all the major emerging markets no longer have a current account issues. Third, it is likely that the phase of stronger US dollar maybe is approaching an end as well. Emerging market equity valuation are attractive at the moment. So, historically, these conditions are associated with a strong return for the asset class in the years which follow. With currency, give you the opportunity to buy real asset at a fair sales price. This is my view. The current account balance creates the condition for a new virtuous economic cycle. Recent example of forced current account rebalance are Argentina, Brazil, South Africa, and India. All these countries has a significant current account deficit until a few years ago, which is now either substantially reduced or even reversed.
Well, Mark, do you agree with this view? Will it be different this time if we look at the next 10 years? You already partially answered in the first part of the conversation.
Yes, I think what the doctor just said is spot on. It's correct. I agree with what he's saying. The importance of currency, of course, is very, very critical when we look at these emerging market countries. The interesting thing is that, as he said, a lot of these currencies have already devalued substantially and now are in a very attractive position. Also, some of the Asian currencies like the Korean won, the Taiwan dollar, have actually appreciated against the US dollar recently, which is a very interesting development, which is quite unusual. Most of these currencies tend to devalue over time. A very important point here is that when we're investing in these countries, we pay a lot of attention to currency weakness and select companies that will not be affected or actually will be helped by the currency weakness. For example, if they're an exporter and the currency is getting weak, that actually helps their business. So this is something we have to pay a lot of attention to.
Okay, thank you. Many analyses point out that actually right now emerging market stocks are heavily under-owned in the global portfolio. Manuela, what should be, how should, and to what extent should the weight of emerging markets grow in the global portfolio to reach a sort of neutral, reasonable level? Manuela.
Thank you, Pierre. Actually, I can confirm to you that emerging markets are, I would say, heavily underrepresented, especially in the portfolios of, Euro investor. And of course, I have visibility on Italian, German, and Austrian, investor. And to be honest with you, most of these private investors still have a very strong domestic bias. So they continue to invest in probably one of the weakest region of the world. Because to be honest with you, if we look at the Eurozone economic performance of the past 10 years has been pretty mediocre, and this was already mediocre before the recent crisis. So, looking at the portfolios, I would say that, Euro investors should at least double up their exposure to, emerging markets. To be honest with you, I don't like to call these markets emerging, but okay, my impression is that most of these countries are way ahead of Europe, okay? So just to give you, an example, especially as far as the bond portfolios are concerned, right after the summer, we decided to increase in a significant manner, the weight of emerging bonds, both our currency and local currency. Most of these countries still offer positive real yield, which is pretty rare. If you look at, not only, of course, the Eurozone, most of our bonds offer either negative yields or very low yields, or even in corporate bonds. But also, if you compare, the high yield market of the US and some of these, bonds of emerging countries, to be honest with you, the risk-reward profile is much better on the bonds of these countries. And recently, we also went overweight emerging market equities, especially, with a strong preference for Asian equities, and especially from China. It's just that you can find very good companies there. Some of these companies are leaders in their sector, especially when we talk about technology. And then if you think about growth going forward, growth is not going to be here in the Eurozone. You have to go, to these emerging economies to find growth.
A listener point out that in the next few months, probably until 2023, emerging markets will contribute 84% of the global growth. So just to confirm what you are pointing out. Another listener point out that companies right now are currently trading at relatively attractive valuations. Carlos, to what extent do emerging markets equities trade at discount right now relative to their own history and relative to the developed world? Carlos.
Yeah, thank you. I think one needs to put this into perspective. One is the absolute multiple you're paying for these companies, and the other important relationship is the price you pay for the potential of earnings over the next coming years. And both parts of the equation look very, very attractive right now. One is in absolute terms, we're seeing that because of the fact that we've seen the largest ever outflow of capital out of these markets in 2020 as a result of COVID. We have seen an even more extreme relationship here. So the relative discount to Europe, to the United States, no matter which market you look at, is close, or this year at least, hit an all-time high. So the spread is the widest we are seeing. And of course, these outflows are normally not permanent. They are a reflection of sentiment, and this can turn around quite quickly. But what we are really looking at is a number of interesting factors. Number one, so we're focusing, and I think one should focus on markets where you see this inflection point over the next years of recovering exports, very strong recovering exports as global demand will normalize. We are seeing that, and as Manuela pointed out there, this innovative private sector, which will play a very large role, and that's very much dominated by countries like Korea and Taiwan. We are seeing that in contrast to the European Union, and I'm a big fan of Europe, but I can see that Europe doesn't have much of an economic policy. Emerging markets have an economic policy. They're supporting certain sectors. They are helping the creation of local champions. So that's another big advantage. Of course, this paired, as I mentioned earlier, with political stability and much stronger consumer dynamics is a good mix overall. So we are seeing that India is really the number one place to search for opportunities. It's a great mix of that macro condition, which is helpful, and very, very smart local entrepreneurs, plus a very open economy, followed by Taiwan and Korea, which are leading in the more sophisticated technologies, catering to the consumers around the world, grabbing market share in everything, battery technology, even space technology, IC technology, semiconductor overall. And then other markets like Vietnam, which we talked about. And I would just throw into the mix, to be a bit controversial, even countries like Turkey are of interest, because this is a place where macroeconomic conditions are not so easy, where the currency has actually depreciated, reflecting inflation, reflecting uncertainty, but the private sector offers a couple of very unique opportunities, which in certain instances are worth investing into, despite the fact that the macro conditions or the countries, especially political conditions, aren't perfect.
As we mentioned, when dealing with emerging markets, flows do matters. Furio, if we look at capital flows dynamics, which countries are likely to be favored by capital inflows over the next few months and years, in your opinion?
Well, we have heard that the demand is pretty high, both in fixed income and in equities, because obviously, if we look at the fixed income side, this government, the change of these countries with the change of leadership, they become more and more virtuous over the years. And some of these countries in the emerging market, like was pointed out before, they are actually investment grade today. So they're, probably it shouldn't be called anymore as emerging, and therefore in the current environment we see a little bit spread across the board with different flavor of risk. The entire spectrum of countries in Southeast Asia or even in continental Africa, opportunities. While in the equities, it's very selective because, like we said, in our experience, we've seen the element of demographics and export have been driven quite a lot of growth in each individual countries. So, and there are companies that become market leaders, and they are challenging the market leaders in different sectors. So even there, we believe there is a lot of growth and a lot of opportunities in Southeast Asia, in China, which still we have seen how has been able to cope during the COVID, and the companies been continuing to grow. And again, we need to have an holistic approach, because even in individual countries like Carlos was mentioning, even in Turkey, we agree as well, there are at the stock picking level very good opportunities. So it depends how you see it. If you are looking at the macro level, at the country top down, or much more at the bottom up level. Having said that, our recommendation in the space of emerging market is, rather than try to make it a macro bet, is always try to be selective, because while certainly, these are countries that have changed quite a lot, and the corporation, they changed quite a lot in the way that they've been run over the years, still require specific competencies and skills in order to select the individual company and understand exactly the drive of the different businesses.
So it's really very important to be selective in the way you approach emerging markets. We are getting some questions again about macro, actually, and we know that many countries in Europe, in the United States, and everywhere are facing the pandemic and further lockdowns. Gianluca, in the very short term, is the development of the pandemic, in your opinion, the main driver for performances, and which countries and regions are likely to cope better with that issue? Gianluca.
Yes, it is important to highlight how China, Taiwan, and South Korea, which together account more than 50% of the MSCI Global Emerging Market, have been among the most successful so far containing the pandemic. This has helped to reduce the impact on their economy and to assure faster rebound. This is the large part of the answer, in a sense. In contrast, other emerging markets like India, Brazil, and South Africa, the pandemic has proven to be more difficult to control, with a younger demographic profile helping to mitigate the negative economic humanitarian impacts. For this country, we are currently witnessing a reduction in the number of daily cases, as distinct from Europe and the US. This may be due to the seasonal impact of being located into the southern hemisphere. I mean, it's summer over there. There may be an element also of herd immunity as well, due to the high prevalence of the virus among parts of the population, like in India and South Africa. For example, a recent serological test in a South African hospital show a greater than 40% of positivity rate. So it's quite impressive. But even if the local virus dynamics are now more encouraging, it's spread in the developed world and will continue to affect the global economic growth and thence emerging market economy as well. We think, however, that positive news flow as to efficacy of vaccines or evidence suggesting a peak in the number of new cases will have investors to look through the current phase of economic uncertainty. Particularly should help those stocks that are more economically cyclical and which have been severely punished so far this year. Once the virus-related uncertainty fades, it's likely that the combination of the economic normalization and the previously announced fiscal stimulus in many countries will positively encourage investors to focus on the economy recovery in 2021, especially those sectors that have been most impacted by the economic lockdown so far.
Okay, Mark, you mentioned the technology sector as one of the most attractive. Of course, we know that the tech sector came out stronger during the pandemic. Wall Street not accidentally outperformed quite substantially other markets. In the US, we know the US markets, the big tech are predominant. My question is, does that hold true also for emerging markets? If you look at tech sector, do you also mentioned some names, but do you think in the emerging markets we can see good candidates to become very good champions for the future on a global basis?
Yes, there's no question that the opportunities in the tech sector are very, very good in the emerging markets for a number of reasons. First of all, I mentioned to you the semiconductor business, which in Asia in particular, which really supply the world with semiconductors. It's an export-oriented industry that's doing very well because of the big demand, increasing demand for semiconductors and other equipment, servers to be installed in cloud systems and other systems around the world. So that's one area. But then you must remember that the internet and the whole revolution of communications with smartphones has created new markets in the emerging markets for all kinds of services. So as a result of the COVID-19 lockdowns, the use of services to deliver food, to deliver any kind of household equipment and other things has exploded in these emerging countries. Now, of course, with the slowdown of the COVID-19 spread, many people think, well, that's going to be over. There'll be no more growth in those internet-related sectors. But that's not the case, because a lot of the behaviors will continue. In other words, people have now been introduced to these new systems and services, and that will not change. So we're seeing a continued growth in the entire technology area in all emerging markets. And by the way, in the frontier markets, it's particularly exciting because you're having a leapfrogging effect where they're going from almost nothing to the latest technology. One of our investments, by the way, is in Kenya with Safaricom, who are operating the M-Pesa system using cell phones to transfer money from one person to another around the country. That's an example of a sort of a leapfrogging into the latest technology in these countries, and that's being spread around the world.
Yes, so mobile payment is probably one of the most attractive sector when dealing with the technology and emerging markets trends. Furio, to what extent, in your opinion, has recent news flow about the vaccine changed the global picture and the emerging market picture? What can you say about that?
But obviously, the vaccine is a good news, and we have seen how market reacted across the board. But having said that, we need to think about the timing and how this implementation is going to pan out. Because obviously, when we think about the vaccine in a country like Italy with 70 million people, is one story. But when you think about the distributed vaccine across the country with 300 million people, like for example, Mexico or India or Brazil, it's not as easy, and the distribution is not as simple. So having said that, I do believe that particularly the larger companies and the larger multinational will be able to access vaccine faster than others, because they will be considered the critical pillar for the business development of each country. So I would suspect that any countries in the emerging market, we need to make choices, the political leaders and and of course how to distribute, and there will be the private sector engaging autonomously to see where to intervene, so what companies, what group should access before this vaccine to keep the economy going and to keep supporting the demand, which comes from the export and obviously as well from the internal consumption. But it's going to take time. Probably it won't be as fast on a generalized basis as we would see in the developed markets and in countries like Europe. But again, going back on the element of the comment I was making before, selectively, we are going to see that happening fast enough, and then we also have to think about that the more people will be vaccinated as well, the more the effect of contagion will be diminished. So we'll see the COVID becoming under control faster, even though it's not necessarily to vaccinate the entire population. So again, it's probably we'll see different paces in different countries, but on the stronger players, I think that is absolutely good news, and they will benefit like any other, players in the developed countries.
So timing is really one of the key issues right now. And Manuela, in talking about timing, is it too early, in your opinion, to reposition portfolios towards more cyclical names and sectors, the one that fall behind?
No, actually, I think it's a good time because, our main assumption is that the combination of expansionary fiscal policy and expansionary monetary policy will actually succeed in lifting a global recovery, especially next year. And if you think about it, monetary policy will stay accommodative for a very long time, especially after, the Federal Reserve last summer announced that they switched to an average inflation targeting. The European Central Bank is also thinking of adopting, this new methodology. And by the way, if the Fed had in place this methodology 10 years ago, they would have never lifted, interest rate, because the personal consumption expenditure, the inflation that the Fed looks at for the past, 10 years, neither on a 5-year average, it has never exceeded 2%. And not to mention the Eurozone, where, the European Central Bank has been making, a wrong assumption about inflation for the past at least, 7 or 8 years. So our main assumption is that we move from a scenario of lower for longer to lower forever. So we really expect interest rates to stay negative or at this level for a very long time. I think that one day we will look at this pandemic as one of the driver of the Eurozone final integration. So I think that without this pandemic, we would have never had the next generation recovery fund. We would have never had the, let's say, first Euro bonds, because effectively the bonds that the European Commission is issuing to fund the SURE, the unemployment fund and the next generation recovery fund, these are Euro bonds effectively. So one day we will say, thanks to this pandemic, thanks to this crisis, we are going to have the full integration of the Eurozone. And something extraordinary, I think, has happened both in the US and the Eurozone, thanks again to this pandemic, is that finally, we have abandoned the principle of neoliberalism, which basically wants government to be small and do not interfere. And now we have finally governments that are, back into investing in the, important sector of countries that actually drive growth. So we are switching to a new paradigm, where, especially in the Eurozone, where most countries have actually cut, public investment for the past 20 years because of the fiscal compact. Finally, we are going to have more fiscal expansion. So all this, to me, points to the fact that we are going to have more growth going forward. And therefore, if you have a long-term horizon, if you're not obsessed, with mark to market and not obsessed with market drawdowns, I think that you should just, actually increase the exposure to equity overall and start buying companies that are going to take advantage of, this money that will flow into the real economy.
Carlos, in the first part of the event, pointed out how important it is to look at a longer time horizon. And what Manuela has pointed out regarding monetary policy and the fiscal policy lead me to a question that we got from a listener who asked, are all that measures likely to make inflation go up? Carlos, what do you think about that?
Well, I think what really matters the most is, again, the bigger picture. And I will answer the question, but I think the bigger picture is that at the moment we are seeing still an unclear US policy, a recent buildup of a wall against a neighboring country, a redefinition of the NAFTA trade agreement, redefinition of many of the relationships. Over in Europe, we are seeing a founding a country of the European Union leading that trade bloc, plus currently two Eastern European countries sabotaging the budget of the European Union. And meanwhile, quietly, we are seeing over in Asia, the establishment of one of the largest, if not the largest, trade bloc via Zoom, so I think it's kind of very interesting what happened over the last couple of days, and especially with, again, now Asia leading with a new trade bloc, showing the world what direction Asia wants to go down, and I think it's inflation is needed, growth is needed. This is not the big issue in emerging markets. You still have real interest rates in most of the emerging markets. But of course, I think it's fair to assume that, a bit of a return to a more healthy inflation environment in developed markets will also help emerging markets, help global consumption, help the financial sector. So it is still within our expectations that this will come back. But the other question, which you also intended to ask about, and just as a apropos regarding the vaccine, I think it's much more a sentiment crisis than anything else. And one of the big impacts that we will see over the next coming months is the impact on a normalization of tourism. And there are many markets which still depend very much on that, including Thailand, Turkey, Egypt, Asia overall. So tourism is I think that's one thing which will come back, which will normalize to some degree, and everything related to that. So that needs to be watched quite carefully.
Okay, we hasn't talked about the politics right now, but of course we cannot not touch the US election. Manuela, to what extent, in your opinion, will current US election results have an impact on emerging markets, especially?
I think they already had an impact, because we have seen some money flowing back into emerging markets. I look at the flows in ETF. And I think that, going forward, we will see more money going into emerging markets. One reason I think is going to be driven by probably a weakening of the US dollar, because, the US is going to continue to run a big current account deficit for, I would say, quite a while. I would expect at least another, support of $1 trillion to the real economy next year. Probably they are going to approve it the first quarter of 2021. So, my impression is with the Federal Reserve continuing to do a very, impressive quantitative easing, we would see a weakening of the US dollar, which should actually drive especially US investors to start diversifying their portfolio again, And so I would expect more money, going to emerging markets. Then as far as politics is concerned, although it is too early to tell, my impression is that we will see a totally different US, totally different approach. I think that the time of isolation is over. Let's not underestimate the probability in 2 years' time that also the Senate goes to the Democrats. At that point, the administration, the Democratic administration, would have full control, basically. So I would expect many things to change from the political point of view that could actually, I would say, make it easier for other countries to deal with the US. And to be honest with you, I also was impressed by, a few days ago, China and other 14 Asian countries, they signed probably one of the most, if not the biggest, trade agreement ever. I mean, going forward, 10 years time, I think that the people who are going to rule the world are going to be different from the people who rule the world now, okay? So we continue to talk about US. I don't know. I mean, let's see in 10 years' time what's going to happen.
And if we focus on the US and China relationships, we know there has been some big problems over the last few years. Gianluca, what can you say about that? Are these relationships expected to meet a turning point or not?
That's a big question, actually. But I think that even though a Biden victory may facilitate increased dialogue between the two countries, we do not expect actually to see an easy resolution to the trade war. We think that the anti-Sino rhetoric will remain. We expect that the US will try to formulate a more common policy approach with other developed countries to tackle the issue, to address themes like intellectual property, but the key one is the government aid to private or quasi-private companies. This is a key point. We expect also that the overall level of political and policy uncertainty to ease once Biden effectively take over in January, with probably a lower degree of unpredictability with respect to the Trump administration. But until then, we could still see some surprises. Recent executive order released after the election on November the 13th to ban the investments by US entities in some Chinese state-owned enterprise, the so-called SOE, seems to confirm what I just said. Those type of measures introduced in the last few weeks of the Trump administration will be also difficult to remove by the administration for clear political reasons, in my view.
So the good news, as Manuela pointed out, is that emerging markets at the end of the day will be less and less dependent on maybe global growth and exports. And the agreement Manuela mentioned is, of course, a key aspect to focus on. Mark, coming back to the election, what are the sectors and the themes that are likely to benefit the most from the arrival of Joe Biden at the White House? Can you say something about that, Mark?
Well, I think the arrival of Biden to the White House is not going to change anything dramatically as regards to whether any particular sector is attractive or not. Because as I mentioned, the technology move, the technology revolution that we're experiencing is not going to stop. It is going to continue. And probably the Biden administration will do nothing to inhibit that kind of growth going forward. In fact, they may even try to encourage more of this growth. But what I believe you are seeing now is a very intense battle between China and the US as regards to technology transfer, as regards to the internet, and regards to intellectual property. This battle will not stop. It will continue. And it's very important to remember that the Chinese now realize that as a result of the restrictions placed upon their companies as regards to obtaining U.S. software, U.S. Hardware in the technology area. They have to develop their own. So they're now embarking on a very intensive move to develop their own operating systems, their own semiconductors that will duplicate what the American companies have been supplying up to now. Now, this is probably a very good development for the rest of the world, because it means that instead of being dominated, let's say, by Microsoft Outlook, the Chinese will have an operating system that will match what Microsoft is offering. The same thing goes for chips. The memory chips offered by the South Koreans will be also duplicated by the Chinese, because they need these memory chips. And now, it doesn't mean that Microsoft will be in trouble or the South Korean semiconductor industry will be in trouble, because the total growth globally in the market is expanding, and the expansion of Chinese companies selling their equipment in the frontier markets in Africa and other parts of the world, in emerging markets, means that the total market size will be growing at a very fast pace.
Okay, Mark, in the first part of the conversation, touched on the governance and the importance of governance when looking at single names, single stories. Sustainability and ESG are actually one of the main topics right now in the wealth management and asset management industry. Furio has the integration between ESG and the pure financial traditional analysis proved to be successful in delivering a persistent outperformance, in your opinion, and is it true for emerging markets as well?
Well, certainly during the COVID, we have seen for the first time where the ESG driven investments have been outperforming the most traditional strategies. So it's the first time where probably we have a clear evidence. But the key thing is that obviously regulation one side that came in force in Europe, which then obviously some similar rules or approaches has been developed and adopted more broadly, more internationally in a number of states. Now we have seen the United States now as in the United States, and now United States as a federation that decided to go back and to sign the Paris Treaty is going to certainly keep pushing towards ESG, and therefore my expectation that this will be conditioning quite a lot the capital flows internationally, and inevitably also for the companies in the emerging markets where the biggest investors are international players, and they will be continue to grow more and more to be international players. And therefore some of the companies that are global multinational, they are already meeting high standards in terms of ESG framework within the ESG framework. Others, obviously, they have a journey to do, but I'm quite positive because I'm certain that we'll see that, particularly the largest one will be, and the one that are exposed to international capital will be pretty much committed. So overall, I think it's also a warranty as well for the investors, because in some of these countries, clearly, the governance might not be at the standards generally. When we generalize, obviously, I'm not talking about because one of the big mistakes in my view that very often we do when we talk about emerging markets in general is that we tend to generalize. It's obvious that there are mega trends that will be supporting emerging markets, the demographic, new consumer, the impact of technology and so on. But we also have to be very realistic and thinking about that all the above generates particular value selectively in certain companies that are managed in certain ways and so on and so forth. So going back to the point, ESG is a trend that, will probably become seamless, because probably will be the only way of investing in the next 10 years. And evidently, I don't think that the emerging markets can avoid, the companies in the emerging markets can avoid to adopt it. And therefore, if they want to attract international capital. And therefore, I think it's a positive trend across the globe.
For sure. Carlos, when you look at single names, can you see companies that show levels of transparency, for example, in terms of governance, that are not far from the level of the developed world? If we look at the three different areas of ESG, so E, environment, S, social, and G, governance, what is the key factor to focus on when dealing with emerging markets and sustainability?
Yeah, and I would first of all very much agree with what Furio just said, that it's very dangerous to generalize, and one has to be also quite careful about using the term ESG, what it exactly means. The relevance of ESG is very different depending on the country, depending on the nature of the business. If you are a business which is highly pollutive, which is, you obviously have bigger environmental issues than other companies which are, for example, doing IT consulting. But overall, I agree that there's not going to be an investment world without ESG, at least during the tenure of our existence on this planet. So it needs to be taken very, very seriously. It matters to investors, it matters to companies, and most importantly, also what Furio said, it becomes a very significant aspect when it comes to your cost of capital. So those companies which are playing by the rules, those companies which have a higher rating, will be able to finance their business ideas, to finance their capex cheaper than those which have an inferior rating. So that's why it matters. It matters significantly. And I think it matters particularly in emerging markets. Of course, if you look at the big scandals, emerging market investing to a large degree means managing risks. And those risks are 9 out of 10 risks in emerging markets relate to a sub-factor of ESG, whether it's environmental fines in Brazil or whether it's labor issues in Bangladesh, those are quite well known, or whether it's regulatory issues in certain markets or transparency issues in China. So it makes sense to really understand those risks as much as possible. In emerging markets, as a matter of fact, companies which have a higher and better transparency have outperformed over the last decade by as much as 20%. So there's a very significant outperformance that is coming from those better rated, better governed companies. For us, to summarize this very briefly, the most important factor to look at is governance. To understand, do companies have proper independent members on their board? Are they qualified? Do they have the right protection for minority shareholders in place? Are they transparent? Are they trustworthy? What's their track record in terms of not meeting certain promises that they communicated? So governance is the single most important factor. And then we work through the various ESG points. We don't use ESG as a term. We use ESGC. So we are adding culture, because we think that culture itself is one of the most important aspects to understand if you also want to get a feel for the potential success and ability to execute ideas in companies.
Thank you. It's quite impressive. People, generally speaking, think of ESG as extra financial parameters and features. But at the end of the day, this ESG and ESGC, as Carlos pointed out, have a strong impact on financials. So it's really, really very, very interesting. Furio, putting all this picture together, as regards valuations, as regards the risks, as regards the growth perspectives. Of course, you need to look at single names, single stories. You need to be selective, but when you put all together, what are the regions and the themes that, in your opinion, are more attractive in this space?
I like to take an advantage, because at the end of the day, I just simply summarizing what my colleagues have raised before. So we see a massive trend in the demographic and the commercial agreement, and so a kind of united leadership in the Far East, and that was something that was mentioned. And certainly, there is going to create more opportunity and more growth. Obviously, the sectors that will be benefiting more, I'm saying macro sector. I'm not going to go in the company side. That there are opportunities around, particularly in the consumer. I do believe that in the healthcare there is a massive change, a massive opportunity as well, because we see that improvement in life expectancies in those countries has been incredible. Access to healthcare has been improving quite a lot. Has been incredible. So these are two obviously very important sectors, including again technology. That for the same reasons that Mark was mentioning before, as a clear evidence, and the distributing model in emerging markets is the same, and is going to be the same of the one we've seen in Europe, particularly from the digital perspective, as an accelerator in terms of reach and distribution. I do believe as well that one another important element is, which we haven't touched a lot, but is the ownership of infrastructure as well. So infrastructure will become more and more important because the different businesses will benefit of unique infrastructure. So there will be leadership for who owns the infrastructure. So that's another sector, an area which I would look at very closely, including transportation, which is very much fragmented at the moment, but clearly there could be massive opportunities there. If we look at, for example, South America, we had even there are opportunities because of there have been markets that have been suffering, like Brazil. We know they went through a rough patch. Mexico, for the different reason, since it was under pressure with foreign policy of United States. So even there, there could be opportunities and investment opportunities, even in the more traditional sectors around manufacturing. So obviously on top of the traditional one that I just mentioned around consumer, for example, in Brazil. So there is I think plenty, but again very selectively, because we need to go on a company by company basis, because when we go back to the element that just Carlo mentioned about the transparency and the companies that have been overperforming, and the one that have been meeting much more developed kind of the developed country standards, have been the one that have the fastest growth, even though we're operating in a sector that have a tailwind because was benefit of potential growth. So I hope that I've been able to address your question.
Sure. Thank you for this picture, and Emanuela. Do you agree with that ideas? Looking at global portfolios, what are the main overweights and underweights as regards emerging markets in your portfolios?
Well, in our portfolio, definitely our overweight is on Asia, especially on China. And, we built this position, I would say now quite a few months ago. And my impression is that we will stick to this bet just because we think that, as China, has proved to be so resilient, even in handling the terrible, crisis that it went into. And actually, it was the first country to go into, this crisis. we expect it really to do well going forward. And also, there is another element that we like, the yuan, the currency. We believe that it's going to be pretty stable, that there is a strong commitment, on China to actually make the yuan, a reserve currency. And so there is all the interest to make it stable. And that's why we have a significant exposure also to Chinese, bonds. So I would say that, this is more or less a pretty structural bet in our emerging market.
Okay, thank you. Just the last question, because I want to leave some space for the Q&A session. Mark, what is, in your opinion, the most underestimated risk in emerging markets? The one that could derail the growth and the financial market from the path that we described today? Mark.
Well, the most underestimated risk really has to do with the developed world, because you must remember that emerging markets, even today, depend a lot on exports to the developed world, and also some exports as well. In other words, the technology that's coming out of the US and Europe is used in emerging markets to help them grow. So I would say that would be a very big risk going forward. So we would like to see these countries in Europe, the US, Japan, Australia, New Zealand, all these countries hopefully will continue to do well because that will also drive the emerging markets growth. And very important to remember that the technology diversification is taking place. Previously, a large part of the technology started in the US. Now it's coming from other countries around the world. And hopefully China, India, and these other countries will begin to take up the torch of technology diversification and help other emerging market countries to develop the technology. So I would say the health of the developed world is probably the most underestimated risk facing emerging countries.
Thank you very much, Mark. We got some questions. One of them is around instruments. Francesco asked, what instruments are better suited for a retail investor to approach this asset class? I would leave to answer Gianluca.
For the question, very, very, very interesting. There are various listed ETFs actually, but in the current phase, we think that a more active approach to capture market inefficiencies and opportunity make much more sense in my opinion. If anything, the strong growth of passive investments in the last few years has allowed for the creation of such investment opportunities. We believe actually that these opportunities are currently being overlooked by investors and they are linked to the more traditional part of the economy like industrial and other cyclicals. In this sector, we look particularly with interest at companies with a strong competitive position, good corporate governance, and a strong balance sheet whose business has been affected by the economic slowdown. This company will be able to withstand the current phase of weak economic growth and should later benefit from the economy reacceleration expected next year. I mean, this is, we are just mentioning the key role of corporate governance. This is the geo and ESG themes that overall is becoming more and more relevant for emerging markets. And it is a dimension that we increasingly need to analyze when selecting companies. The importance of good corporate governance is self-evident and comes from the simple recognition that the ability of a company to generate profits is only one part of the story. We also need to consider the willingness of the company to share those profits with minority shareholders and to reinvest the capital, considering the value addition to all shareholders and not only to the majority owner. In our experience, we have had several instances of emerging market companies which were attractively valued on the surface, but which were constantly penalized by investors who were concerned about poor allocation of capital, like the Chinese state-owned companies, for example. For this reason, when we analyze a company for our funds, we give a lot of weight to the management's track record on capital allocation, and we aim to make sure that management and minority shareholders' interests are aligned.
Some other questions. Zeno asks, is it the right moment to invest largely in Turkey with a midterm strategy with such low prices? If I'm not wrong, Carlos mentioned Turkey at some point during his answers. What can you add?
Yes, well, I've actually lived in Turkey for over a decade and invested in Turkey. So I think it is it's a highly interesting economy with over 80 million consumers. It's a very open economy with a couple of very strong exporters. So I think to ignore Turkey would be a mistake. Of course, Europe is a very important and large trading partner, but Turkey is also increasingly opening up to the east and connecting with China and Asia. So I think Turkey really offers a bit of the old world, the typical larger incumbent businesses around telecom and banks and infrastructure. But there are also a number, and we have actually invested in two companies in Turkey. One is a software business, which is a leading software developer in Turkey, and they're doing very, very well. They're also benefiting from a weaker lira because they have 25% of their revenue are actually in euros. So it always makes sense to look at that profile as well. And then we invested in a business which is a fashion retailer, a branded fashion retailer owned by a family, controlled by a family. They're exporting increasingly to neighboring countries. A very large market share, very strong brand. Branded businesses are the ones which we find particularly interesting. So Turkey is interesting. You have to have strong nerves. You have to pick the right stocks. I don't think it necessarily makes sense to buy the market because they also have a lot of challenges with a chronic current account deficit. They depend on importing foreign savings in order to finance their growth. They are suffering from high inflation, and the banking sector is vulnerable. So you have to be very, very selective in Turkey.
Again, be selective is really the key approach to invest in emerging markets. Just another question in this case is about South Asian countries, and especially Julius has a question about Indonesia. Is it a place where you can find attractive stories right now? Mark, do you have something to say about that? Indonesia.
Yes, Indonesia is a very, very interesting situation because you do have some excellent companies, but at the same time, Indonesia faces a history of quite intense corruption. This, is a holdover from the colonial period under the Dutch administration, where the corruption was engendered, and of course, it's an incredible country in terms of the scope of the many islands, the thousands of islands, and the separation between these islands makes it very difficult to have a unified approach to the country. Nevertheless, of course, the most important island is Java, where Jakarta, the capital, is located. But when dealing with companies in Indonesia, you have to take into consideration what they face in terms of the government corruption. In other words, what they have to do in order to survive in that kind of environment. So if we pick companies that are not so dependent upon government licenses or any kind of favors or administration benefits from the government, then you're in a better position to operate. So I would say that's the big challenge that we face with Indonesia. Nevertheless, with such a large population, there are lots of opportunities, and we're looking at them continuously.
Okay, thank you, Mark. We are approaching the end of this live stream. Many thanks again to Mr. Mobius, founder at Mobius Capital Partners. Thank you very much for being with us, Mark.
Thank you.
Thank you to Carlos Hardenberg as well, co-founder at Mobius Capital Partners.
Thank you very much.
And many thanks also to Manuela D'Onofrio, Head of Investment and Solutions at UniCredit Group. Thank you, Manuela.
Thank you for having me here tonight.
Thank you again, Furio Pietribiasi, Managing Director at Mediolanum International Funds. Thank you, Furio. And thank you, Gianluca Serafini, CEO and Managing Director at Fideuram Investimenti. Thank you
much to everybody.
Thank you, everyone. Thank you, dear listeners. I invite you to follow our next live stream on Monday, 8:30. It's Weekly Bell, our weekly update on emerging markets. Again, thank you very much and have a nice evening.